We talk about the idea of things pushing and pulling, especially in the bond market. It's very, very obvious. The push of the back end or the pull of the front end can cause the markets to go in different directions. The challenge we've always got is, how do we know which one's doing which? Well, it's sometimes, not always. Sometimes it's obvious. One market's stationary, the other market's not. And this is the Grail trade version of the bond curve, of course. If we talk about the Grail trade version of bond curves, this is what we're talking about, because obviously we know that the response to a higher short end is usually a lower back end. That's the normal push-pull response. And it depends how it affects. Now, obviously, if this is a lot less, there's obviously a trade here, isn't it? This becomes a trade. This is hard to trade, isn't it? Well, yes, it is, because the effect is having too big an effect. It's having too much of an effect. So which one's driving this? We don't know which one's driving. But if we have this situation here, it's quite clear what's going on. If this is going up, and it doesn't matter whether that's the 2s, 5s, or the 5s, 10s, but it will matter in due course. But at this point in the discussion, it doesn't actually matter which one this is. If this one's going up, this one should be going down. And if this one's not going down, that means this one is under accumulation. So there's a lot of buyers in this, which means there's probably a lot of sellers in here. That's how you change the shape of the curve. And we basically think about it as if the front end is steepening, the back end will be flattening. And when we're talking about back end here, we're talking about 2s, 5s, 5s, 10s. Okay? It doesn't have the same dynamic back end that the knob spread has at the 10s, 30s part, but it's still a back end, front end trade. So obviously this buy in here, this buy during this phase, this should naturally place sell pressures down into this phase here, and that's why we can see that accumulation. Well, in that world, in this world here, this is normally going to be the response to that in due course, after that accumulation has been completed. And you might be thinking, well, this makes bond trading very easy and very obvious, except for a fact, if this is the back end of the curve, the bond price will be doing exactly the opposite. So we've not got the trade on. The trade won't exist. So the best thing that can happen actually is for this to be the front end. This to be basically the 2s, 5s in this case. So if this is the front end and it's leading, this is the kind of bond trade that we do 100% want, because in this environment, of course, hold on a second.
And Ray had to step away for just
Sorry
a second.
Okay, so what would we expect the bond prices? What we're hoping to see on bond prices, of course, is something that looks a little bit like this, perhaps. And if we see something that looks like that, because the back end is still pretty static, we obviously understand that this is going to be an enormous opportunity to sell bonds. Enormous opportunity to sell bonds into that story. Now, the problem is, if this is the front end, that's what we're going to get. But if this is the back end, so if this is, for example, the 5s, 10s, the bond price won't be up here. Of course not, because if the 5s, 10s is rising, the probability is the bond price is actually doing this instead. The bond price is selling. So the chances of us joining in with that bond price is pretty slim. The probability is, though, that that's going to give us what is called a parallel shift. So we are trading, if this is the front end, what we're going to be trading is a passive sell response at the top edge. But if I change this now to if I change this storyline around a little bit to this, we're still expecting the same outcomes. We still expect that type of outcome there. But if this goes from the 2s, 5s to now the 5s, 10s, if we change this to the 5s, 10s, of course, the bond price will not be running a top line. The bond price will be doing this. And what we're going to get when we get this response, of course, is we're going to get that continuation again. We're going to get that continuation, aren't we? So what's going to happen is that we're still going to be selling these trades, but we're still going to be selling them more on probably on a down phase. We're going to have to recognize which is driving at which point. So this is what we can start to understand a little bit about this change here. As the 5s, 10s is rising here, as the 5s, 10s is rising, this is under accumulation. Because as somebody's buying the 5s, 10s, there's sell pressure coming in the 2s, 5s, but the sell pressure in the 2s, 5s is getting adjusted by the hold here, aren't they? The accumulation is now starting to show up as visible. We can start to recognize some of this by looking at the 2s, 5s against the 2s, 10s, or by looking at usually by looking at the 2s, 5s against the 2s, 10s, we see that divergence appearing. And that's what makes some great bond trades, because that tells us the right trade is in at the right price. So when I see the best trades possible, I'm always looking at that story evolving in these areas here. So when you see that little bit of divergence there, that's a buy trade in bonds. When you see this divergence here, that's a buy trade in bonds. When you see this divergence, that's a buy trade in bonds. We're getting the best of all worlds here. As we come down into this phase here, this could be and should be a buy. This could be and should be a buy trade here. But obviously the drop-off was a little bit severe and fast during this phase, and it cancels out the ability to make that reversal trade here. But into the bottom edge here, I like this. I like this trade here a lot. That was at 10 o'clock this morning. And obviously since then, you can see there's not really been an awful lot we can get involved in, except still to be running this programmed trade here. You can see that that trade is still the right trade to be on here. And that's what we're seeing in this phase. That's what we're seeing in this phase at the moment. And obviously when we look at those trades as far as bond outrights are concerned, of course, these should always be the opposite. The bond should always be a buy trade in these locations. When we look at the bond in those locations, we can already recognize that that buy trade there is this bottom edge on bonds here for that big rally. This buy trade here, perfect rally. This buy trade here, perfect rally. This sell trade here, decent drop. And this sell trade just in here, on the retest, yep, that's what we're doing just now. We're in that bond at the top edge at the moment, looking at this as a possible trade. Now, there is I said to Sam, there is a problem with this trade at the present moment, and I'll touch on that in just a second. Okay, so what is the problem with this current trade? Well, one of the problems we've got just now is the inflation break-evens. This inflation break-even should be positively correlated, of course, to the curve. When we look at inflation break-evens, the challenge we've got is the inflation break-evens are actually getting murdered today. So that makes life very, very difficult to buy the curve off the low prints. Now this one looks okay because inflation break-evens are adjusting lower on a macro scale basis. They're actually, they've been low, they've adjusted back down again into this area, but this seems to be a little bit discounted in this area. It seems to be a little bit net discounted. So I'm not really worried about this one. I think that's a very perfectly reasonable trade here. But what I am worried about, of course, is this continued sell-off here on inflation break-evens. That puts a sell into the top line up here, allows you to make the right decision at that stage and buy bonds, doesn't it? Yes? So you'd have been buying bonds into that squeeze. That was at right on the cash open. Everybody gets that, yeah? So right in the cash open, you're going to be wanting to buy bonds right at 1 o'clock, 20 past 1, and that obviously took you from 199.04s to 200. Now, obviously, when the inflation break-evens have improved slightly into the low price, if we were to zoom into the charts at that stage, you can see there is a very marginal improvement from a point-to-point basis between these 2 points here. Very marginal improvement, but the macro is still dangerous for this bond. So it's very, very difficult to keep that sell trade going just now. That's the one that I was worried about when Sam was talking about it. But I'm happy to join Sam on the retest for that reason. I mean, there's a very small advantage for me doing this. And I think the shape of the curve allows me to try and take advantage of what I'm seeing up here and just grab a little bit of business here. Hopefully the inflation break even stays in play here. And that's obviously what we're starting to see in the trade. So when we start thinking about this as a storyline, I am currently short bonds now off of the 200 02s, 200 01s, 200 evens. It's currently trading at 199.24s. The inflation break-evens micro are with me, macro are against me, and therefore I've got to be very, very cautious about it. I've got to make sure I get my stops in at break-even, and if it goes, I'm in it. If it doesn't go, I'm scratching. Simple as that. Make sense, guys? So when we looked at this morning's London, this cash open today, we can obviously look at the inflation break-evens as we move into the US session proper, of course. And when we moved into the US session proper, you want to try and get a read on the gap on the inflation break-evens. The first thing you do is try and get a read on the gap, and you can see the gap was very, very aggressive to the downside. Well, we already thought that would be the case because of that drive lower. As it came down, of course, you're very, very aware of this situation. That's not a good thing. Of course, that's not a good thing. The other thing we can obviously add into this is looking at those fives. If we look at the fives inflation break-evens to see whether we're getting any difference between the fives and the 30s, we can see there's a little change taking place here. You can see that the 30-year inflation break-evens is higher than the 5-year inflation break-evens. So 30-year inflation is higher. Well, that should be a sell on bond, surely, shouldn't it? That's called a steepening curve. If the 30-year inflation break-evens is higher than the 5-year inflation break-evens, that means inflation further out is more. That should be bearish bonds, yes? So the relationship between the TIPS markets and the TIPX markets gives us some narrative about curve shape, doesn't it? That's what we would understand from that little storyline at the present moment. But obviously, it's an evolving story. We can try and figure this out in due course. Early diddles into this at the moment, guys. Early diddles, and we'll have to see if it sticks around for the rest of the day. We'll have to see what situations evolve from this.